This video is sponsored by 21 Shares. More about them in just a couple minutes. Now, this week we saw bad labor market data from across the U.S. economy, but we also got one piece of information from the ISM that helps explain exactly why we're seeing what we're seeing in the U.S. labor market. Their backlog index fell to its lowest level since May 2009. Yes, the backlog number hasn't been this weak since the depths of the Great Recession. Now, along with that, we've also seen job cuts announced by ConocoPhillips, the company reporting maybe as much as 25% of its workforce is going to be cut, along with a back-to-office policy instituted by Paramount, another service provider, that is explicitly stated to be a way to get U.S. workers to quit their jobs, cost-cutting all over the labor market landscape. And I'm talking, of course, about backlogs. The amount of work that service providers have already booked has fallen to such a low level that unless service providers get a lot of new business in the door really soon, they're going to have a lot of workers just standing around doing nothing. We all know what that means. In fact, we got a taste of what that means in the payroll estimates that just came out this past week. The reason why, in all likelihood, the establishment survey was negative in all 4 months of the summer so far has a lot to do with those backlogs, or should I say, the lack of backlogs. So in the wake of everything and what that all means moving forward as far as the U.S. economy goes, we've got markets screaming all over the place. Market interest rates are falling. Forward interest rates are falling. We've got copper prices that are down, gold prices that are soaring. We've got a brand new, really low on the copper to gold ratio. And all of it ties back together with this one concept. And this is a concept you might recognize because Mr. Steven Van Metre has been talking about backlogs for quite some time already. And here we go. Now it seems that the U.S. services sector of the economy is out of them. So Steve, Mr. Van Metre, backlog. I mean, I know you're not surprised, but maybe you can give us a sense of how important this is. Not just the, backlogs as a concept, but the backlog index for service providers, the lowest we've seen since the depths of the Great Recession. This is pretty big stuff.
Yeah, Jeff, I think I've been thinking about this for 3 years. So
yeah, for quite some time. Yeah.
We've had some runway on this because the question I've continued to ask is, when do these run out? Because this is, again, what's really keeping people employed, because we've already know there isn't enough new business out there to sustain the workforce. So no problem. You've got some backlogs. You put your workers on it, and we continue to see contraction after contraction, but somehow the whole thing continues to hold up. And then we saw, of course, consumer confidence jump. We know that had everything to do with the stock market. Then out of nowhere, it started plunging again. And Jeff, this is my belief. I think people are going to work, right? And they're looking around, they're realizing like, hey, the amount of backlogs, they're going down and quick. And then they look over to the fax machine and on the wall, and I'm like, new orders aren't really coming in that quick. And they start to realize, if we don't get enough new orders in and these backlogs go away, due to all of the uncertainty going on in the business climate, and of course the margins are getting squeezed due to the trade war, the boss isn't going to keep all of us here. Now, I've been watching the hours worked. We didn't see that drop off in the last payroll report, but there's a huge drop in, of course, the backlogs. This is what, as you mentioned, showed in the services sector. We saw the employment part contract. Now, it doesn't mean layoffs. It could just mean hours are getting cut. But again, this is all a symptom, because my belief is once those backlogs are gone, the U.S. economy, we're going to hit that air pocket, we're going to hit the cliff, and next thing you know, we're going to follow everybody else down.
Yeah, that was the part about the non-manufacturing PMI, is that there was a lot of consistency there. Not only did the backlogs number really fall that far, the employment index has been well underneath 50 for, I think, 5 out of the last 6 months, which goes along and backs up what we're seeing in the payroll estimates, the household survey, rising unemployment. And there's a consistent economic picture, the one that you've been painting for us for all this time, which is companies at some point have to say, look, I just don't have enough work. I want to keep you on my books because I don't want to have to train somebody else to replace you if the economy does pick up. But I just don't have the work for you. There's nothing coming in. I don't see anything on the horizon that suggests things are going to pick up. So I'm going to start laying some people off. Now, it doesn't happen all at once necessarily. You start trimming, like Steve said, you cut back on some hours. You stop hiring people completely, and maybe you do let a few people go. That's how the process starts. And so what we're seeing in all of these indications is that The US economy and the labor market might really be at this important critical tipping point. And it goes along with something else that you said last week, Steve. You remember how Jay Powell and basically the mainstream media and economists and everybody who gives predictions and forecasts had said, hey, just hang in there. The second half of this year is going to be great. We went through some uncertainty, a little bit of a soft patch, no big deal. When we get to the second half of the year, we'll get beyond all this tariff stuff. We'll have everything settled down, and you can start beginning to go back to work again. So we're getting into the second half of the year, and rather than things improving, things are actually deteriorating, which is not a good sign when everybody's hoping that, just fingers crossed, everything magically turns around. Before we get back to the rest of our video, I want to tell you about our sponsor, 21 Shares. Here's the thing. Crypto can feel incredibly complicated. Between figuring out wallets and keys and staying up with constant changes, it has not been easy for everyday investors to get started. That's where 21 Shares is different. They've built a structure that takes the best parts of crypto, freedom, long-term potential, innovation, and they make it accessible through regulated ETFs. Instead of juggling multiple platforms or worrying about technical details, 21 Shares lets you access assets like Bitcoin and Ethereum right inside the same brokerage account you already use for stocks and bonds. That means you can take part in one of the most important shifts in finance today without having to jump through hoops. It's simple, transparent, and it is designed for the long game. So if you've been waiting for a more credible way to explore crypto, this might be the most practical starting point you'll find. Check out 21shares.com and sign up for their free newsletter. You'll get updates, insights, and a clear look at how they're building the bridge between today's financial system and tomorrow's. This content is sponsored by 21 Shares, but please keep in mind, investing always entails risk, and their products may not be available in every jurisdiction. So please consult a licensed financial advisor before making any investment decisions.
Yeah, Jeff, because, put this from the worker's perspective. Again, they're going to work and they're saying, look, I don't have that much work. So, you look at all the, the data in the housing market. Are rate cuts going to fix it? Well, if you're going to work and thinking, hey, at the rate things are going, the best solution is I'm going to have less hours. The worst is I'm going to be out of work. You don't go home and say, look, let's buy a new house. Let's buy a new car. Let's go spend a bunch of money. It starts to feed all back through the economy. So the consumer gets worried. And then what do we start hearing from executives? Oh, hey, all this front running the tariffs, we don't think it's going to last. We think things are going to get worse. So we're not hiring due to this increase in demand. We're just going to, tell people, hey, it's going in the backlogs and we'll get to it when we do. The employees figured it out. They're cutting back their spending. And now employers are starting to get worried that we don't have enough new business. But in a sense, it all comes from the top. It's spilling over. And again, you talk about the inflection point, and I agree. I think we're right there right now. If consumers don't come out and spend, Jeff, like for the holiday season, start spending soon, I think this inventory overhang is the major problem here. You look at manufacturers, they're already saying, look, demand's down, production's dropping, our need for employees is going down, and it just starts to spill all through the economy. And the more fear that you see in workers that are seeing this in real time shows up in the confidence survey, shows up in retail sales. And again, whether there is a 25 or 50 basis point cut, at the next meeting, we can debate that. It doesn't matter. That's not going to get people to go out and spend.
No, and I think let's be clear about when we're talking about a tilting point in the economy. What we're really talking about is what Steve just said, is you get into these second and third order effects where it becomes this vicious cycle. So consumers are worried about their jobs, so they do exactly what Steve says. They start cutting back, even if they're not, they don't know that they're going to be let go, or they don't know if they're going to have their hours worked or hours trimmed. So they just out of caution, it's just a natural reflexive instinct. Okay, things are not going well at work. I'm not going to go out and buy that extra little thing that I thought I was going to do. I'm not going to take another weekly vacation this year. I'm going to maybe bank those funds and keep them in the bank. But as consumers pull back in their spending, it then feeds into revenue for retailers and manufacturers, and especially service providers, because now they see less income coming through the door, less revenue. And so what are they doing? They're thinking, oh, we're getting less revenue. We're working through our backlogs at almost a record pace. Though they start the process all over again. They start talking about cutting even more hours, giving up raises, not hiring people, maybe even laying a couple people off, which then convinces consumers they need to cut back even more. And as consumers cut back even more, then businesses cut back even more in jobs. That's the tipping point that we're talking about, where just a slowdown starts to become more serious than a slowdown. It gets to be a downturn that gets to be really serious. And then once it tips over into that vicious cycle, it's like the little snowball rolling down the hill. Once it gains just enough momentum, it really starts to pick up speed really fast. And by the way, this is what Jay Powell was talking about. Jay Powell, the inflationist, the guy who kept saying tariff inflation, tariff inflation, tariff inflation. At Jackson Hole, he said, look, we're starting to see these worrying signs in the labor market where it's maybe the snowball hasn't gotten to that tipping point just yet, but we can see a road and a path toward it. So the reason we're leaning toward cutting rates is because we want to stop the momentum in that snowball before it gets to be too far. And what Steve and I are saying is it might already be too late.
Well, Jeff, I don't think rate cuts would have made any difference at all because, one thing we talked about, several times on your show is demand going to drop faster than prices can go up? And it did. And so businesses were like, we're going to pass on price increases. And I go, wait, we can't. So we started to absorb it. And you kind of mentioned, you talk about margin squeeze, and this is another issue. We heard this from UK companies that said, look, tax increases was a problem, but the second one is profit margins. And look, at some point, you're going to see businesses go into survival mode. And even if it means they're just going to tell, some people say, hey, look, that order we told you was going to get in 4 weeks, it's going to be 6 because I got to lay some people off here, or you're never going to get your order to begin with. And so, again, you talk about the challenges that this economy is facing right now. And I agree. I 100% think we're at a tipping point. The problem is the rest of the world's already tipping over. And there's still this hope that, hey, the Fed will come in to the rescue here and it'll change the trajectory. But I want to remind people is where the rest of the world goes, we eventually follow. And that's what we're starting to see here in the payroll reports is things aren't that good. And backlogs around the world, I don't know when they dry up, Jeff, but I'm going to go with this. I think we're within a 90-day window now. When that happens, as you said earlier, businesses don't have the cash and wherewithal to sit around and say, hey, you know what? I'm just going to hang on to you for a while because I don't want to retrain you. I think that in the position, due to the trade war and the tariffs and squeezing margins, they're going to have to lay people off. They'll tell them, hey, if things turn around, I'll hire you back. The problem is workers already know there are no other jobs.
And I think that the marketplace is getting right. I mean, exactly what you said, that once we get to the tipping point, the probabilities shift very quickly. So that's why you see in the cash treasury market, for example, the 2-year treasury falling to its lowest yield since 3 years ago, which is basically telling you that there's going to be more cutting from the Federal Reserve. It's not going to work. It's going to lead to more cutting. And as you and I have said from the very beginning, this was going to be a prolonged series of rate cuts. The Fed always frames it, and other central banks too. They always frame it as, well, we're just going to cut a couple of times. That'll be enough to steady the situation. And we'll just, we'll hit the soft landing. We'll fine tune just enough to make sure that we do. And then that will be the end of it. That's why every central bank, including the Fed, has been like, we're going to pause here. We're going to pause here. We're going to pause here. They think that they just do a couple rate cuts and it works. But you and I have been saying all along, because the markets have been telling us that was never the expectation. The expectation was once this stuff started, the Pringles can analogy, they were going to have to continue with the rate cuts because it wasn't, the weakness in the economy was only to get worse. And now we're at that situation where the markets are shifting pretty radically and pretty quickly. Like I mentioned, copper to gold ratio. Copper to gold ratio, which is a key inflation, or really reflation versus deflation signal, historically validated, very strong, very compelling signal, corroborated with a whole bunch of other indications all across the marketplace. Copper to gold has been moving steadily negative for the last several years. It's almost like the copper to gold ratio has been corresponding very closely with the backlog, or the backlog measure. They both can be going down slowly over time, and for basically the same reason. Well, copper to gold over the last little while, since copper prices came off their tariff high, copper to gold just plunged. That's less than everything in 2020. That's less than every single time in 2008 and 2009. And what that means is that we still have a lot of negative economic potential moving forward. This is not the end of it. This is only the beginning. And so in terms of interest rates and the Fed cutting, the Fed is still closer to the beginning of its rate cutting than to its end. And now we're getting all this confirmation from across the macroeconomic landscape that says, yes, we can see a path forward, maybe even the most likely path forward, where backlogs have hit the wall. And that means that there's going to be more aggressive a more aggressive response in the labor market. And there's only added urgency to do that because of Steve just said, on top of everything else, these businesses are seeing their margins being squeezed, which adds that level of urgency, which then explains what we're seeing in the marketplace.
Yeah, Jeff, because we've been talking about how the economy doesn't go down in a straight line. And so it goes down and then plateaus. Every time it hits a plateau, what do we hear? Oh, that's the bottom. And then, of course, the data ticks up a little bit, which is expected. Oh, there's a soft landing. And then it's like, well, wait, nope. And so you downslope again. And then we've been at a little plateau here, and everyone's been saying, nope, this is it. This is the bottom. And the Fed, I don't want to say they're brilliant, but one thing they did very, I think, differently this cycle is they made it clear that, hey, we're going to restrictive territory. Like anybody knows what that actually is, because they wanted everyone to believe that so they could come out and have some safety cuts here without spooking the markets that, hey, we got this wrong and we're going into panic mode. Now, is that 25 or 50 basis points? I don't know. I mean, we'll hear from Powell and company, on the 17th, but still what we're seeing is that supply and demand imbalance from the global economy that got skewed during the pandemic and then got skewed again during the front run of the tariffs keeps slowly coming back into balance. And the problem is everybody keeps saying, when does this thing stop going down? And we're about to enter that next leg down. The problem is, I think this is going to be a long slide before we get to the next plateau.
Yeah, and I think the markets all agree. I mean, we'll talk about another one, oil prices. Oil prices are down again today, even though there's some geopolitical support for oil. ConocoPhillips just this past week said, yeah, we're kind of throwing in the towel here on oil. We're going to cut 25% of our workforce. And they're not the only ones who did that. Earlier this year, Chevron made the same decision. They said, we're going to cut 20% of our workforce. Yeah, that's in the oil space, but the oil space and energy overall is representative of what Steve just said, which is demand was just never there. We continue to slide lower and lower and lower because the rebalancing in the economy to actual fundamental levels of demand versus supply are just not favorable to anybody in the oil space. They hired too many people because they were expecting demand to be a lot better than it ever was. And now they're coming to the realization that, we've got too many workers. Oil prices have no chance of coming back. We need to get rid of it. 25% of the company. That's a massive slashing that is, unfortunately, I think too emblematic of what we're thinking and what we're seeing across these economic signals. So as the energy market is going through that reckoning of understanding where rebalancing is taking place in the economy, we're seeing these signals over here in the services side as well as manufacturing. Steve, you talked about inventories. That's another one. That's really what's at the root of all of this is rebalancing demand with supply. And it's more fundamental equilibrium. And unfortunately, it's a lot lower and a lot less than people have been either expecting or told to expect by all of these so-called experts. But the markets have been pricing this scenario all along, saying, look, this is where we're going to end up going. And as we go through time, we go through this back and forth, that's the trend. And the trend continues to be in that direction. And there's nothing that says that it's going to change.
Yeah, Jeff. And so you think about a couple of things that happened during the pandemic. One, you had a large number of baby boomers retire because they didn't want to deal with things. And the stock market went up much to their benefit. And then you had the work from home movement. And again, you kind of mentioned before the show, there's now being a big push by companies saying, look, we need to lay people off. And so the plan is you're all coming back to work. If you don't want to, well, then you quit. So, you start to think about demand from the economy. Well, we know people that are retired just don't spend quite as much, but they do go on a lot of cruises, but they don't need to buy as many cars because they're not going to work. They don't need to drive as many clothes because they're not going to work. So their spending tends to go down. Could go down a lot more if we see the stock market drop. But again, you see all this lack of demand in the economy that came out of the pandemic, but because all the shelves were empty, there was this huge new normal that, hey, there's going to be this massive surge in demand. So we overproduced. I forget what the Chinese term for that. We have too much production now.
Neijuan or something. Neijuan, I think, is what they call,
yes.
They call oversupply.
Oversupply. So I think that, so we have way too much supply, not enough demand, and the imbalances have to come back. And kind of just like we're seeing in China with manufacturers competing with each other, we're seeing that now in the fast food space. McDonald's, hey, we got to have our extra value meals are back. I remember when they said this was a brief thing that they were going to have specials, and I said it's not going to happen. It's going to keep coming back. Less competition there's more competition, fewer people, prices come down, Fed cuts rates all the way into a recession.
Yeah, and we've got all of these indications coming in from all over the place, whether it be in the marketplace or these announcements. The one that Steve was just talking about, Paramount. Paramount said we're going to institute a back to office policy starting in January. And if you don't like it, you can take our buy. You tell us by September 15th, and you can take our buyout. But for once, Paramount said this is explicitly stated. This is a cost cutting measure. This is not anything other than trying to get employees to quit. And if this was taking place, I mean, companies try to lay off workers all the time, but you put that together with ConocoPhillips and the backlog number from the ISM, and then the recent payroll reports, and then combine it with the market signals, copper to gold falling, treasury yields falling sharply, forward rate curve that's becoming even steeper and inverted, and the inversion going further out in time into 2027. All of these things combined tell you that the economy is indeed at a tipping point. And it does not matter if the Fed cuts by 25 or 50 in September, because whatever they do in September, it's going to be followed up by more. Even if it's not in a regular series of rate cuts, the economic circumstances demand low interest rates, and that's exactly what we're getting.